Hello, what's up? Good morning, good afternoon, good evening, depending on whenever you are seeing the lectures. Today, we are going to start with overview of equity securities. And after that, we'll be doing the other readings. But this is where the core of equity begins. And you'll understand what exactly equities are, how are they valued, and it's going to be a small gist of what you're going to see later on in level 2 and level 3. So welcome to the session. Hello, everyone. What's up? How are you all?
Good morning.
Morning. So we will be starting today with overview of equity securities and a very interesting reading, and it will form a very good foundation for you all when we proceed towards equity valuation. Okay, so what you can see right now on the screen is the overall index about what we are going to cover. So we are going to understand what are the different types of equities. Now, many of these things we have already covered in bits and parts in the previous discussions as well. But here the focus is going to be much more in detail about what is equity market and in what is global equity market. So equity markets are not only those which are publicly listed stocks. There is also a private market or private mode of investments into equity. So that is what we are going to see, private investments in equity. Then what about investing in foreign securities or non-domestic securities? That is an interesting part we are going to see. What are the risk returns in equity and what is the cost or expected returns or required rate of return in equity? These are the things that we are going to cover in this particular reading, right? So let's begin with what is equity. But before I make you all go through what are the different types of equity, let us understand the global equity market and where the market has been in the last century overall. So I'll be sharing some important information and data which will help you understand that why equity is the preferred mode of investments for all. And that's what you can see right from the screen. Equities are most favored asset classes globally, most favored, okay? But that's not always the case. Many, we have discussed in the previous sessions also, many people do not start investing in equities initially. They start investing indirectly into various risk-free avenues, right? Starting from term deposits to investing in government bonds and so on. And later part in the life, they invest in equities because they find equities very volatile, very risky, or they take time to understand this particular market, right? And many are scared with the, as I said previously also, with volatility, the high deviation in the market, that you can perhaps lose everything. That's the part that people take time to enter into the equity markets. But once they enter, I think it's more like an addiction. You can't escape from it, right? So equities are the most favored assets globally, right? People have made fortune and have also lost in many cases, right, in equity markets. Well, there is an interesting data that only 2% of our countrymen are billionaires, right? And there are equivalent amount of, if you see the percentage of people associated with equity market, they are investing or they've raised capital through equity market is also the same 2% around. So you can make a very good correlation that those billionaires who are in India, they have either invested in equities or have raised their capital through equities, right? So equities is an inherent part of you being a billionaire. Okay. Passive investors buy and hold stocks in a well-diversified portfolio, right? And then there are active investors who continuously buy and sell securities in the search of alpha, right? We've discussed about passive and active investments. Those are the two ways through which people, those are the two type of nature that people have when they invest in equities. Correct. Now, here's what I want to show you, the last century's, trend of equity investments. And we've compared that with bonds and bills, short-term instruments, right? Quite visibly, you can see from 1900 to 2020 data. What do you notice here? Of course, equities are the ones which have given you higher real annualized returns. Real means after the adjustment of inflation. Okay, so these are real returns. On a real return basis, you will see quite visibly equities have outperformed everything. Am I correct? Right? So what do you see in the last century around, if you see globally in all the countries, this is a trend which will perhaps tell you that in all the countries, nothing has outbeaten equities than anything else. If you will see any country that you see in the downside, in all the countries, equities are outperformed all the other classes of assets. Now, we have not mentioned here real estate or gold, but equities have surpassed all of them on a real return basis. Clear? That is, after inflation, equities have given the maximum returns. Everyone clear? Now, I will also show you one more graph, which will tell you around 133 years of history of the equity market and how the equity markets, geographically, how the equity markets were. Basically, if you see on your left hand side, you have the 1899. That's in the 1900s. What was the equity market? Which was the most dominant? Which was the country with most size of equity market? The biggest size of equity market in the 1900s. You would see UK, right? Because British Empire was the largest at that time, right? And then if you notice in 2021, there's a substantial change. Of course, US has become the dominant market, isn't it?
Yes.
Right. But you would also see the rise of Asian markets compared to the 1900s, where the Asian markets were hardly visible. Now you would see in the era 2021, you'll see Japan, China, and many other Asian markets like Taiwan and Korea coming up, right? This is a very substantial change from the previous century. That, it's very much said that this is the century for Asia. If last century was for the Western countries, this century it is said to be for the Asian countries, back to where it was before 1700, when Asian economies like India and China had more than half of the world dominance into trade. Now it is said that Asian countries are back in the front after 300 years. Okay, so that's the size of equity markets as of today. And I've shown the same size in a different graph. So you'll see the current status of equity markets. US is having the highest share in the equity markets globally, followed by Japan, China, and other countries. Clear? Of course, China is increasing very fast, and gradually, I would not be surprised that in the next decade, you will see China at the top, right? And somewhere, hopefully, India in the top 10 as well. Now, let us understand which are the largest exchanges in the world. The largest exchange, of course, which everyone knows, is NYSE. New York Stock Exchange is the largest, then followed by NASDAQ. But the third one, surprisingly, is Hong Kong, followed by Shanghai. As I said, Chinese indexes are growing, Chinese markets are growing very fast, and it shouldn't be a surprise that they take over or they move ahead of the US exchanges as well. Then you have various other exchanges, and somewhere near there in the top 10, you can see something to be proud of. National Stock Exchange of India, NSE, right? So NSE is one of the largest stock exchanges in the world. In the top 10, you can say perhaps. But do you know the oldest stock exchange in Asia? It's not China or Japan, it's Bombay Stock Exchange. Bombay Stock Exchange is one of the oldest stock exchanges in Asia, right? Everyone?
Yes.
So I'll share you quite interesting history of Bombay Stock Exchange in some other session, but it was the oldest stock exchange funded by an individual, and where it went, what happened to that individual, I'll discuss about that in some other session. It's a very interesting story about Bombay Stock Exchange, how it started under a banyan tree and where it is today. Anyways, so, Indian Stock Exchange is also in the top 10 list, right? Okay. Now, you will also see some various surprising stock exchanges like Tehran Stock Exchange, Iranian Stock Exchange also, valuing in $1 trillion. So it's not that these nations are, I'm very surprised, and it's also a very interesting thing that a country which is perhaps cut off from all the nations of the world, Iran, it is being sanctioned by US, by Europe, by many Middle East nations who don't like Iran. It's very surprising to see that how the country is self-sufficient. It has a very good oil market, even though it is having a lot of embargoes and sanctions. Somehow it is, managing its economy. I'm not saying everything is good there, but they are doing their best even after the currency is being depreciated. It's a very interesting case study to understand how a country in today's era is surviving even when the entire world, almost the entire world, has sanctioned them, right? North Korea is a very, not a good example to understand, but Iran is somehow, we need to, analyze. As a financial analyst or an economic analyst, I would recommend you all to understand how the Iranian economy is still surviving, and how are they, by facing so many sanctions, their situation should have been as worst as Venezuela, but it is not. And somehow, somewhere, they are self-sufficient in some things. So even though they don't have as much as oil as Venezuela has, still their situation is not as worst as Venezuela. And even after so many sanctions by US, just imagine if US puts sanctions on someone, all your funds are blocked, all your investments are stopped, all your trades are being halted. How would a country survive? We just can't imagine that thing happening even for a month. And Iran is surviving that for years and years. So, of course, it's out of topic discussion, but this is my recommendation, that try to understand how Iran is still flourishing, right? And not to the great extent, but just imagine that how that country is surviving. It's a very interesting case study. If you get time, you should go ahead and try to research more about that. Okay. So yeah, that's the global financial market. Now let's understand, since equity is something that excites everyone, because what you see even in the last century, equities are the one which has given the best or the most phenomenal real returns. Let us understand more about equities. So, two types of equities which we understand. One is common shares, and second type of equities? Preferred shares, everyone, right? So common shares and preferred shares. What is the biggest difference between common shares and preferred shares? Even though I'm going to discuss that, can you tell me what is the biggest difference between common and preferred shares? Even though they both are shares, what do you think is the biggest difference between both?
They get the fixed dividend. Preference shareholders get fixed amount, fixed dividend.
Okay.
Voting rights.
But
Voting rights.
Yes.
Voting rights, sir.
Voting rights, yes. Apart from dividend, the biggest difference between common shares and preferred share is the voting rights. Voting right is only limited to common shares. Preferred shares do not have voting rights. Okay. So it is, even though we call it as shares, somehow I disagree. Personally, I disagree with preferred shares being called as shares, because they just give you a share in the income, much like the debt holders, right? But they don't give you the share in the company's profits in terms of a stake. They do have you. Likewise, you can say the debt holders also have a share, correct? Even though they have a fixed share like preferred shares. But of course, debt holders have a priority over the preferred shares, and preferred shares have a priority over the common equity shares. But common equity shares are the ones, they represent the ownership. They actually represent the ownership. You are the ones who are going to be the decision makers because you have the voting rights. And whatever is left in the company after paying off to debt and preferred shares, that is the residual part, belongs to the common shares, right? Everyone? So voting share is one of the biggest differences between common and preferred shares. Now, since you are focusing on to common shares and voting rights, what are the two very essential type of voting rights? First is statutory voting and second is cumulative voting. Statutory voting means that you have one share, means you have one vote. One share is equivalent to one vote. That is statutory voting. Isn't that a very common type of voting, which you all are aware, that one share, one vote, right?
yes.
But an interesting type of voting is cumulative voting. Cumulative voting, in order to make you understand what exactly cumulative voting is, I'll have to share you an example here. So let's assume that there is an annual general meeting where the voting is to be done for the appointment of 3 board of directors. So 3 board of directors are up for the appointment. Ideally, you have 1 vote for each of the directors, right? Let's say you have 100 shares. So how many votes you can give to 1 director? You have 100 shares. So how many votes you can give to 1 director?
1 vote.
100
3
shares.
votes.
1 vote is 1 share is 1 vote, right? So I can allocate 100 votes to 1 director. I'll repeat, 1 vote is equal to 1 share, or 1 share equals to 1 vote. Are you getting it? So if you have 100
votes.
shares, you have 100 votes, which you can give to all 3 directors. Let's say director A, director B, director C, all are up for appointment. So you have 100 votes for A, 100 votes for B, 100 votes for C. Correct? That's called a statutory voting. So what is the maximum vote you can give to a director? That depends on the maximum shares that you have. If you have 100 shares, how many shares can you give to a particular director? Or how many votes can you give to a particular director? Not more than 100. Are you getting my point? Right? So assume that there is only 1 director up for appointment. There is only 1 director for appointment. Then if I have 100 shares, I can give 100 votes for him or her. Isn't it? Everyone? Yes or no? Everyone?
Yes.
Now, the question is, will my 100 votes count? Well, what if someone has 1,000,000 shares? Then that particular organization or individual will be able to put 1,000,000 votes. So naturally, those who have more shares, their decision will dominate the overall decision of appointment of directors, isn't it? So can I say here, the minority shareholders like me, who have only 100 votes or 100 shares, we are, somehow being suppressed by the majority stakeholders, isn't it? Correct? So to make this correct, there is a cumulative voting. Under cumulative voting, now you need to understand and do respond. In case if you want to join in here, do ask me, because I also need to understand whether you all understand this concept or not. Okay, otherwise it will be just a video running on. So now take the situation. There are 3 board of directors up for appointment. I have 100 shares, so I can maximum give 100 votes for all 3 of them, right? That's a statutory voting. But as I said, the disadvantage of statutory voting is that who will dominate here?
Majority who has more shares.
The majority who has more shares and therefore more vote, right? However, under cumulative voting, if I have 100 shares and if there are 3 directors up for the appointment, so instead of giving just 100 to each, total I have 300 votes, right? Under cumulative, I can use this entire 300 votes to vote for 1 director instead of allocating that to all the 3 directors. Are you getting it? So I can use my other 100 votes, which I had been allocated for the other directors. I can use that and put that to favor my director, which I want to get appointed. In that way, all the minority shareholders can accumulate their strength and appoint a director that they want. Are you getting this difference? So see this, what I'm going to read. For voting 3 board of directors, each 100 shares would have 100 votes, right? If it was a statutory voting. But 300 votes for any director, any 1 director, you can give 300 votes also, right? If it is a cumulative voting. Are you getting this point? Everyone? So instead of my strength going as maximum 100 votes, now I can give 300 votes to 1 director. Of course, then I won't have votes for the other directors, but that's how we can give more power to the minority shareholders. Everyone, right? So statutory voting and cumulative voting. Everyone understands what is cumulative voting?
For statutory voting, like 100 votes for each director means like maximum. Okay, if there are 3, okay, if there are 3 directors, then 100, 100, 100, right?
to each, right?
To each. Okay, but I'm limited to only 100 votes
Right.
per director. Okay.
Correct. Now in cumulative, you have 300 votes. Entire 300 votes you can allocate to one director. So all of a sudden your power is thrice to a particular director that you would want. Are you getting it?
Yes.
Right. Now, I know this may not look like a substantial change, but this is one step better in terms of corporate governance. Are you getting it, everyone? Clear?
Yes.
Now, many organizations, since shareholders are across the globe, they also give you the option of proxy. So you can vote by proxy if you are probably located somewhere else, right? So to avoid geographical limitations, companies allow votes to be done by proxy as well. Is that clear, everyone? Now, like bonds, common shares can also be callable and puttable. What is callable? Callable means here the issuer has a right to call back the securities when he or she wants. So let's say I am the company and I have issued the shares. So I have the right to take back the shares from you at some point of time in the future. That is called callable shares. Clear? Puttable shares are shares where the investor has the right to sell the shares at a fixed price whenever the investor wants. So can you tell me callable share gives power to issuer or investor?
Sure.
Issuer. And puttable shares give power to investor. Of course, which type of share will have more demand and therefore more price? Callable or puttable?
Puttable.
Puttable shares will have more demand and therefore more price compared to callable, right? Because puttable is like going to be an insurance. Whenever you think that the shares are falling, you have the right to sell the shares, let's say at $100. So your value will never go below $100. Are you getting it? So it's a benefit to the investor or the holder of the share. Clear? Everyone?
Yes.
That's a puttable common share. Now these are phenomenal which are discussed in more detail in bonds, where you have callable and puttable bonds, and that's very interesting part there. In fact, in level 2 you have everything about callable and puttable bonds. So that's also possible in few shares. Not many shares are callable and puttable. Very rarely you will find callable and puttable type of shares. Everyone clear with that? Right. Now, one thing we had discussed in corporate finance, basically in corporate governance, was the different classes of shares. Different classes of shares means not all shareholders enjoy the same rights and privileges. Many founders, like we had discussed that with Facebook, Google, and Alibaba, these founders and key or prominent executives of the company, they have ownership to superior voting rights. Superior voting rights, so they have created class A, class B, class C type of shares. Now these are special voting rights for them. So they have, probably you can say, the veto power whenever it comes to vote, like the United Nations Security Council, where the 5 nations have the veto power as to which country will what will be the fate of a country. That's what is decided in UNSC. So in the same way, you have a board with superior voting rights, where there are different classes of shares. So the superior classes not only gets greater voting rights, but they also have seniority in terms of claim in case of the company is liquidated, right? Such shares are not issued to common public, and therefore there is more control by the founder. That's why even Mark Zuckerberg may not have around 50% stake in Facebook. He may hardly have around 10 to 15 or 20% at stake. Still, he has more control on Facebook than anyone else because of the special rights that he has, special voting powers. Now, it's not that people are not aware about it, but that's already been disclosed to the SEC as well. And only after that, others, buy the shares. As I had discussed in corporate finance also, we in India also have such type of shares with Tata Motors. You have Tata Motors DVR. Am I correct? DVR
Yes.
means differential voting rights. Now, of course, when your rights are less, your share price will also be at a little bit of discount compared to the main shares. Is that clear, everyone? right? So that's all about common equity. Anyone, any questions about it? Right. The classes may also be treated differentially with respect to dividends, split, and other transactions. All this will be not hidden. All this will be mentioned in the SEC, SEC filings, or whichever regulator you are basically, reporting to. All those regulators will have those specific conditions mentioned with respect to shares. In fact, when you subscribe for an IPO, you get a red herring prospectus. Remember, red herring prospectus is like form S1, right, in SEC. So that RHP, red herring prospectus, is the one where you get all this information in advance. So there's nothing hidden. However, you have to understand that this gives more power to the founders or promoters. Clear? Now, after understanding everything about common shares, let's now move to preferred shares. Preferred shares, as we have understood, that they are called shares, but they have more of characteristics like debt. So they are also called as hybrid instruments. They don't have voting rights. They have fixed dividends, which are given to them before the common equity shareholders. They have priority in claim in terms of liquidation, and they can be convertible as well as non-convertible. If you remember from a discussion on in FRA as well, what is an analyst treatment for preferred shares if they are redeemable or if they are non-redeemable? If preferred shares are redeemable, then you treat them more like a liability, a debt. And if they are non-redeemable, then you treat them more like equity. Clear? Similarly, if preferred shares are convertible into equity shares, then you remember, right, there is going to be an dilution in the EPS. Am I correct? Yes. And if they're non-convertible, then comes a question whether they are redeemable or not. If they are redeemable, treat them as debt. Clear? Like common equity and bonds, preferred shares can also be callable and puttable, right? And the maturity, if they are redeemable, the maturity can be anything. As I said, it can be limited or it can be perpetual. Is that clear, everyone, about preferred shares till now? Right? Okay. Now, preferred shares can further be classified as cumulative and non-cumulative. Cumulative means that whatever dividends you are the company is liable to pay you. Let's say the company is liable to pay you 10% of dividends every year. Now, what if due to some profit issues or due to lower earnings, company is not able to pay you dividends at a particular year? Under cumulative preference shares, this dividend is accrued even if not paid, and it is accumulated, and later on when there is profitability or when there are positive earnings, it is this all accumulated dividend is first paid to the preferred shares, and only after that common shares are paid. Everyone, that's called cumulative preferred shares. So in cumulative preferred shares, your unpaid dividends, if any, do accrue over a period, and then they are paid in full whenever the company has better results. They are paid in full to first the preferred shares, and only after that common shares are paid. Clear, everyone? That's called cumulative preference shares. Everyone clear?
Yes.
Contrary to this, non-cumulative preference shares are those where, let's say, if the company did not have enough profitability and it is unable to pay you dividends for the current year, then your dividend is gone. Then your dividend is forfeited and you would not get those dividends which the company was not in a position to pay. So either you get or you don't get. That's the situation. But they are not accrued like in the cumulative. So of course, which one is better from the investor's point of view? Which one is better from the investor's point of view? Cumulative or non-cumulative?
Cumulative.
Of course, cumulative, right? Clear? Now, ideally, what we have understood is that dividends are in preferred shares are fixed, correct? Now, tell me one thing. What are the three different ways? And I want everyone's participation here. What are the three different ways through which you can invest in a company? Everyone. What are the three different ways through which you can invest in a company?
Equity.
Correct.
common shares
Right.
or preference
Right.
Or
and
bond.
debenture.
Debentures or bonds, right? Everyone clear? Now, I want someone else also to answer here. I have Deep, Divesh, Jay. Everyone can perhaps rope in here. Just keep your voice a bit loud. Tell me one thing. What is your, if you invest in a startup, what do you naturally think would you want to invest through? Equity, debt, or common equity, preferred equity, or debt? Anyone can answer.
Common equity.
I've got one vote as common equity. Anyone else? Something else?
Common equity.
Common equity. Everyone agrees to common equity, or anyone has some else view? Common equity, everyone. Now, what if a startup, you put money in a startup? You know, all these startups burn a lot of cash, right?
Yes.
Do you think startups are profitable?
No.
No.
Well, if they are not profitable, then what is the only way for you to exit from a startup? Have you ever thought about it? What is the only way through which you can exit from a startup? Well, only if the startup is listed in an IPO. Correct? Now, quickly, guys, everyone is an expert here. Tell me top 5 startups of India, or any startups that you know. Quick.
Zomato,
Airbnb.
Flipkart.
Zomato, Flipkart,
Airbnb.
India. Airbnb from India. No, India specifically.
Zerodha.
Flipkart, Zerodha. I don't think so. Zerodha is a startup, but it's okay.
Fintech.
Fintech, yes, you can say. The Robin Hood of India, Zerodha.
Zomato.
Paytm.
Or
Then?
ATM.
Then, come on. What else? Only 3?
Zomato.
Paytm.
Zomato is done. Zomato is done. Flipkart is done. Paytm is done. What else? Just check out your phones and you'll get the startups that are famous in India. That's it. Oyo. Well, if you can say Airbnb, why not Oyo? Ola. We have the, duplicate version of everything. For Uber, we have Ola.
Swiggy.
For Airbnb, we have Oyo. We are expert. Now people accuse China and Korea of copying, right? We are nothing different. Instead of Amazon, we have Flipkart here. And by the way, the founders of Flipkart were working in Amazon. So anyways, that's altogether a different story. But Flipkart, Paytm, Oyo, Zomato, and Ola. Let's consider these 5 main startups, okay, for now. Tell me, since how many years are these startups into India now? You know, at least 5 to 10 years?
Yes.
Yes.
Right? As of date, even though there are a lot of discussions and planning going for them to be listed, are these startups listed as of date?
No.
No. Had you been an investor at the first round in Oyo, Flipkart and all, how would you exit? How would you exit? I understand your valuation has become from $1 million to $1 billion, or maybe more than that. But how would you exit? Well, the only route you may have is to find another buyer in the second or third round of funding, isn't it? But the major route for everyone to exit is to go through an IPO. And do you think startups go to an IPO within a span of 2 to 3 years? Well, if these 5 India's largest startups, even after 8 to 10 years in the business, if they are not able to get listed because of the environment and the valuation, how can we expect a mediocre startup to get listed so easily? Are you trying to understand my point? So by investing through common equity, what do you get? Now, these are the 5 to 10 startups that you are aware. What about the other 999 startups which have failed? There are many startups which have just vanished in front of your eyes, right? Now, had you been a common stakeholder, a common equity holder there, you would have lost everything, isn't it? So my
Yes.
question to you is that the best way of investment is not actually common equity. The venture capitals who have the expertise of investing in startups, they prefer to invest in startups not in the form of common equity but in the form of preferred equity. So they at least get something from the startup before the startup gets listed. Otherwise, you don't get anything. You're getting my point? So instead of common equity, VCs have a mode of investment into startups in the form of preferred equity. And in preferred equity also, they do two things. First, their dividends are participating. What do you mean by participating dividends? Participating preference shares are those shares where your dividend is synced to something, or it is benchmarked to your performance. So let's say the commitment is about 10% minimum, and if the company does X amount of profit, you'll get 20%. If the company does X plus something, you'll get 20 plus something profits. So over and about the fixed preferred dividends, you also get additional dividends if the company's performance exceeds a target level. That's called participating preference shares. So what a VCs or venture capitalists do when they invest in a startup? First, they try to have participating preference shares. So their dividend is not fixed. Their dividend is also increasing. Are you getting it? Second, what do they try to do? They try to make it cumulative. So if they don't get a dividend in one particular year, the dividends are accrued. Are you getting it? And the third that they try to do is that they make these preference shares convertible. So when the time comes for an IPO or new round of funding, you can convert these preferred shares into common equity and get a better valuation. Are you getting my point? So a smart investor in any company would want to have what type of feature? Instead of common equity, what would you prefer now?
Preferred equity.
Preferred equity? Just preferred equity? How would
Convertible preferred equity.
I would rather say cumulative participating convertible preferred shares. I would want these type of investment when I invest in startup. I would want everything on the platter. Are you getting me? Everyone. So VCs negotiate with the startup that we are willing to put money in your business, but you should issue us cumulative participating convertible preferred shares. Everyone clear? That's the best type of investments.
What if all the options are not available? Like all
Who
four.
money more, the VCs or the startups? Who is more keen to get money? Just see the table. On which side it is tilted more initially? Who is in more need, the VCs or the startup companies?
VCs.
Do you think the VCs are more?
No, startup companies.
Startup companies are more desperate initially, right? Later on, when the startups become unicorn, then when it becomes $1 billion company, then probably they may ask for more. But initially, when you need that seed capital, right? At that time, the VCs are also smart enough. They are ready to put you. They are ready to give you funds, but they can put such conditions. Are you getting it?
Yes.
And a startup founder may not mind, right? As long as, what if you negotiate with the VCs that, okay, give me some special power, give me the veto power, issue DVRs for me. Okay, so they may issue DVRs for them. They may issue cumulative participating and convertible preferred shares for the VCs. And then the common shares or basic preferred shares are issued for all types of shareholders. Clear? So non-participating preferred shares are where no extra money is paid and you get just a fixed value of dividend and par value on maturity. Is that clear? Right? So cumulative, your dividends accrue, and participating, your dividends can increase. But the third thing I told you all to add into it is make the preferred shares convertible. So convertible preferred shares are the ones where you get shares on the conversion after the conversion period, right? So instead of getting your principal back, you get some fixed amount of shares, right? What is the advantage of holding a convertible preferred shares? Well, it allows you to get higher dividends than common shares. Second, if the share prices increase, then definitely instead of you getting par, you get more money on maturity. And compared to equity, the preferred shares are relatively less volatile because your dividend amount is perhaps fixed, not like equity, it is vulnerable. And you also have some downside risk in terms of preferred shares. You get a priority of claim in liquidation, and many times it is also said that it is also committed that you'll at least get your par value back in case if the shares go down. So that's not an option available in common equity. If the shares go down, you may lose a lot of money, but in preferred shares you have a floor on the downside that the value will not go below that floor, right? It's like a puttable share where you can sell the share at least at par value. So those are the provisions which makes preferred shares more safe and secure than a common share. Everyone clear?
Yes.
Now, is everyone alert? I have a question for everyone here, and I would want everyone to participate. It's my humble request. Can I ask the question? Everyone. Everyone, yes.
Yes.
So everyone has to answer me, what are the 2 or 3 types of IPOs of stocks, shares that they have heard recently or anytime? We'll start with Deep. Any IPOs that you have heard recently or in the last couple of years? Tell me any 1 or 2 IPOs that you have heard about.
DMart.
DMart. Next.
Kalyan Jewelers.
Okay. Kalyan Jewelers. Okay. Anything else?
Mazda Dog.
Sorry? Okay. Mazgao Dock.
Mazda Dog.
Right. Okay. Jay,
Yes, sir.
any 3 IPOs, 2 or 3 IPOs, which you can tell me in till date, which you have heard about randomly and a bit loud?
Anupam allotment, sir.
Sorry?
Easy Trip,
Okay. Easy Trip.
Lakshmi Rasayans,
Okay.
SBI cards.
SBI Cards. Correct.
Yes.
Divyesh, can you hear me?
Yes.
Any 1 or 2 IPOs that you can tell me, which you have heard about?
Barbecue Nation.
Barbecue Nation. Okay. And
Craftsman Automation.
which one?
Craftsman Automation.
Craftsman Automation. Okay, great. Deepti, any IPOs which you have heard about?
I was about to tell DMart.
Okay, go on.
Most of them.
You can tell about North America. Any IPO that you were aware about or you had heard or you were thinking to put money? I was an IPO analyst, so whenever I hear or think anything about IPOs, I become very excited. Any, you can say, you can, which are the recent listed companies? Saudi Aramco came up with its IPO for the first time, the world's largest company. Okay. SpaceX has an IPO, had an IPO. Okay, so there are many companies which came up with an IPO, which you all are aware, right? Now, have you heard about any bonds being issued? Yes, governments regularly issue bonds. Then there are many non-banking financial corporations which issues NCDs, right? Non-convertible debentures. Have you heard about it? Right?
Yes.
Like a Shriram Transport Finance coming up with its bond issue, government of India or government of US or government of Qatar or UAE, They regularly come up with bond issues. So all that is in the news, right? Correct, everyone? You must have heard somewhere the bond being issued, right? At least everyone.
Yes, sir.
But have you all ever heard about a preference share issue? And I can be very much sure no one must have ever heard about a preference share issue in any of the news or media. Have you ever heard about any preference share issues? Ever? Anywhere?
No.
Yes? Anyone? All those who said me about equities, have you ever heard about any preference share issues in any news or media or any articles? It's more secretive. Issuing a preference share issue is more secretive than, I would say, than a CIA or Mossad. It's that secretive. You'll never find a preference share issue out in the public. Are you getting it? It's like similar to, have you ever heard a company saying that we have a CEO's position vacant? You see a lot of openings, right? For sub-managerial level and analyst level and so on. But have you heard about companies saying that, oh, we have a position vacant for CFO and CEO, let's float resumes. Let's ask for resumes. Have you ever heard about that? Everyone?
Nice, sir.
No.
No, right? Why? Why is the CEO or CFO's post not out there in the open?
Demand इतनी है, sir. There is always be excess of supply.
Okay. And how do they assign it? Don't they assign it internally itself?
Yes.
Right? Now, why was I saying this example when it came to preference shares? Well, don't you think preferred shares are so lucrative for an investor? Why would they be issued to common man? They are definitely issued for promoters, group companies, friends, relatives, or some high net worth individuals or some qualified institutional buyers. Are you getting it? So they are perhaps distributed or issued within the narrow group of investors rather than everyone. Clear? So you'll never find any books telling you that preferred shares, why are they not issued in public? This is the fact that I realized during my time of IPO analysis. This was not mentioned in the book. I used to always wonder, why is there no preference share issue out there in the open? And I always saw that when I was reading the red herring prospectus, I always saw that always the preferred shares were convertible and those were issued to the family members of the promoters or some cross-holding or some subsidiaries of the promoters' companies. So I always saw that there being a very good correlation between preferred shares and the company's own stake and the company's promoters. It was more like I should not name as an insider trading, but it was more like a related party transaction. Are you getting my point, everyone? Clear? So that's what I wanted to discuss about common shares and preferred shares. Everyone cleared? Anyone, any doubts? Any questions, anyone? So now let's move to another way of investment in equities. One way we all know is, how do we invest in equities? Well, we invest through public placements or we directly buy it from the secondary market, right? That's called from the stock exchange. That's called public investment in equity securities. Now, the other way of investing in equity securities is private investments. Private investments is like, taking a stake directly in the company and not buying these shares from the open market, right? When companies are in need of money, they can issue the shares from the open market, that is from the public through IPO, or they can privately place these shares to some, as I said, qualified institutional investors. So compared to public securities, private equity securities are issued to institutional investors via private placements, right? They are smaller in size and they do not have an active secondary market like stock exchange trading, which you have for public securities. Therefore, there is lack of liquidity there. So as a private investor, if you want to sell off your shares, it's very difficult for you to do it because your shares are not listed. Is that clear? However, since you are one of the prominent investors in the company, you can negotiate with the company when it comes to pricing of the share. So there's a very good scope of negotiation for private investors. It is difficult to obtain financial information in such a case. Why? Because these companies are not the companies which are taking private investments rather than going through public. They are not mandated by the SEC to publish their information. They are not mandated by SEC to disclose everything by the SEC regulations, right? So which company will be more transparent? The one which is listed through SEC or one which is privately placed? Of course, the one which is listed on the stock exchange, which is regulated very well by the SEC. That will be more transparent, more open to information rather than someone who is raising money privately. Is that clear? Right? So there are benefits and disadvantages when it comes to buying private stake. Is that clear, everyone? Everyone?
Yes.
Yes.
Now,
Yes.
there are three types through which people can privately invest in equities. Of course, the most famous one is VC, venture capitals. Then you have leverage buyouts. And third is PIPE. PIPE is basically private investment in public equity. Let's discuss one by one. VCs, venture capitals. Venture capitals, why are they called venture capitals? Because they invest mostly in companies which are at a development stage, which are at an early stage, or which require capital for expansion. They are at the nascent or initial stage, right? They have a neck of shortlisting companies which they see or which they feel will be multi-bagger based on their forecasting. So VCs invest in companies that are on early stage of development and require additional capital for expansion. What are the type of VC investors? Well, they can range from an individual to a family or a group of wealthy individuals, right? VCs can be anyone. Now, when there are individual HNIs who invest in a company, we call them angel investors, right? So angel investors are individuals who are like high net worth individuals and they want to diversify or they want to have a stake in the upcoming company. So they put a lot of money. Those are called angel investors, right? Normally, what is the time frame for a VC investments? Well, they invest with a time horizon of 3 to 10 years. As we discussed in case of startups, normally a startup would take to start, to grow, to become a global company, it would take around 3 to 10 years of a time horizon. So VCs are there from the initial stage and they may want to be there, till the company reaches certain value, right? The funding objective here for the VC is for development and growth. They may invest the funds when the company's it is a very idea stage, which is called seed capital, or when the company wants money for expansion or for growth, for global expansion and reach, or maybe the company wants to get ready for an IPO. So VCs invest at different stages. We'll discuss at more in length about VCs in alternative investments. In alternative investments, we have an entire section on VCs. So that's where we'll discuss at more in length about this. But remember, VCs invest at different stages. Now, the lower the stage, the earlier the stage, the more risk it is, because there is a higher chance of failure at early stages, right? But also more returns, because that's the point where you get where you get to invest at a lower value. Is that clear? Right? So someone who had put money in Flipkart or a Paytm or Alibaba when they were listed, or when they were just at an idea stage some 20 years back, they would have made substantial wealth, isn't it, everyone? Correct. Now, how do the VCs exit? Well, they can exit when the startup becomes public, when its shares are listed in an IPO, or someone else buys the startup through a merger or acquisition, or a different rounds of funding. A VC goes through a startup goes through different rounds of funding. round A, round B, and so on, or different rounds of funding. And at those different rounds of funding, you can perhaps exit to the new investor. That's how VCs may exit. Mostly the VCs wait till the company becomes, the company gets ready for an IPO, because that's where they get maximum value. Or a strategic buyer may, take over the company. In such a case, VCs may, exit. Clear, everyone? Some of the prominent VCs I've just named for your reference: Tiger Global, Sequoia Capital. Sequoia is something that I was very excited to join. Of course, they hardly hire people from commerce background. They hire people from IIMs and IITs and Harvard and Oxford. So Sequoia Capital, a very interesting VC. SL Partners. SL Partners is very famous for investing in one of the most famous startups at the very initial stage. IDG Capital, 500 startups. Y Combinator. Y Combinator is an accelerator which does programs for startups, which gives them training, which provides them logistic and ecosystem for them to become a multi-bagger. Very interesting. Y Combinator. Whenever you get time, do research about it. Khosla Ventures. It's a very, very famous VC in US by, I think, Vinod Khosla, that guy's name is, right? One of the prominent figures in the Silicon Valley. So there are various startups, there are various VC funds which invest in the global startups. Clear, everyone? Everyone clear about VCs?
Yes.
Right. Now, the second way of investment in private investments in companies is through leverage buyout. Leverage and buyout. Buyout, first of all, means taking over an entire company. Leverage means debt. So leverage buyout is a situation where the company's management or a private equity partnership or a group of individuals taking over the entire company, buying the entire company by usage of debt. So they use a large amount of debt to purchase all of the common shares outstanding of a publicly traded company. Well, what do they do? Well, they raise debt capital, they raise borrowings, and with these borrowings, they buy up the equity of the company. That is called leverage buyout. It's a very risky thing. Now, this is called LBO. In short form, it is called LBO, leverage buyout. Now, who can do this, by the way? I told you two types of people can do it. At times, there are private entities or group of individuals or HNIs which can do this. Or many times there are companies inside, the management itself takes the control over the company. They buy the shares of the company by raising debt capital. When the management is involved in doing this, when the company's existing management is involved, we call this as a management buyout. Everyone. So leverage buyout and management buyout. When an LBO is performed by the management, company's existing management, we call that as a management buyout. Clear, everyone? Now, why do companies raise so much of debt capital to take over a company's control? Well, first of all, let us understand that the company is probably running through some financial problems. The company's business is good, but the company is running through some financial mess, right? So the company requires restructuring. Restructuring in the sense that some of its debt has to be paid off or some of its equity has to be taken over. So the objective here is to restructure the target company and later on take it public. So right now the company is going through financial mess. Let's say in many parts of the world, the steel industry is not doing great. Why is that so? Because of huge amount of dumping of steel by China. So most of the steel companies in the world are finding it financially difficult to run and operate. And therefore they have had huge amount of debt in their books. But the business is not bad. It's a cyclical business, so it's very vulnerable. So, many investors have you heard about this guy, Lakshmi Mittal? The richest person in UK,
Yes.
right? And this guy is the owner of ArcelorMittal, one of the world's largest steel companies. In fact, the largest, I think. So what was his strategy? He used to always take over the companies which are good in business but in financial problems. He used to take over this company's debt, turn around, and then merge it, and that's how he became a steel giant. So leverage buyout is more of like that. You invest in the company by raising debt capital because you believe in the company's operations. You may find the company being in a financial mess, but the company may have good business. So you restructure it, you make the company better, you start making the company profitable, and then you sell it off to a potential investor. But it's a very risky thing. Why? Because what if the company does not turn around? Then you may lose a lot of amount, and you may end up taking the debt burden of the company. Clear? So what is the typical process of an LBO? After the shares are purchased, the company's shares cease to trade. The investor group takes full control of the company, and eventually the company is then privatized. So the public company is then privatized because you take over the holding, and now you become the major stakeholder, and there's no need for the company to be public, and there's no need for the company to take shareholder approval for everything. You become you delist the company. Are you getting it? That's the process of a typical LBO. Once the company turns around, then you again list and sell it. But temporarily you delist so that you get control of the company and so that you can take some important decisions, right? So features of target companies, what are the type of companies that they take over? Large amounts of undervalued assets and generating high level of cash flows. So as I said, these companies are operationally doing very good, but they may be probably having too much of a debt burden due to which they are not having positive profits. So just imagine if you just take over the company's financial control, and if the company is doing good, then you can probably make the company profitable after a period of time, and then you can sell the company. Okay, that's a leverage buyout. Remember, management buyout is a part of leverage buyout only. If the management is involved in taking over the company, then the LBO is called an MBO, management buyout. Clear, everyone?
Yes, sir.
Any questions, anyone? Right. Okay. Now, the third type of investments, private investment in securities, is through private investment in public equity. Now, in short, it is called PIPE. Here, the investment is in a company which is already listed, right? And compared to LBO, where too much of debt capital was raised to take over the company, and the target company was in a stress, here that's not a situation. Here, the private investment or the done by an individual or a group of private investors, they pick up a stake in the public company, which needs capital to grow. And you know what they do? They probably, they also try to delist the company. That is one common part. Like LBOs, they try to delist the company. So what is the process? The investors pick up stake in a public company that is in need of quick additional capital. Urgency and size of capital required by the public company provides significant discount to the private investors. So the private investors know that the company needs capital quickly, so they may negotiate with the company and get the stake at a discount. Now, this capital, why do the companies require capital? Not for survival, but they require capital for significant expansion, high level of indebtedness, or to overcome some problems in the operations, right? So compared to LBO, where the basic objective is for the company to get turnaround, here that's not the only case. The companies may also do this for rapid expansion or growth, right? What if my company is public and a big investor like Warren Buffett or Bill Gates comes to invest in my company? Then I may be happy to delist the company, take that capital, and take a huge leap in the business, right? In the past, companies like Burger King, right, where 3G Capital had invested, then Dell Computers, these were all listed companies. Okay, they were delisted when private investors roped capital into it. So Burger King was delisted. Dell Computers was delisted when Michael Dell himself decided to delist the company. He bought back or repurchased the shares along with the help of Silver Lake Capitals, and they delisted the company. And then after a gap of, I think, 4 or 5 years, they turned around the company, and then they came up with and then they listed it again. So in the past, this has happened with Burger King, Dell Computers, and also Heinz. Heinz, known for? What is Heinz known for?
That's very
Ketchup, right? So Kraft Foods was basically, I think, Kraft Foods had taken over Heinz. So Heinz was a company where Berkshire Hathaway, Warren Buffett put his money, and they delisted the company and they listed it back again, and then it was merged, I think, with Kraft Foods. That is from Yum Investments or Yum Foods. That's a subsidiary of those companies. So anyways, trying to tell you that these are examples of the companies which were having private investments in the companies, in public companies. Then they were delisted, and after a period of time, they were listed again. So, for short term, you require a lot of funding, and that funding can be provided by private investment also. Not necessarily every company goes for an IPO, or every company goes for the secondary market, to get funds. They can also get funds from private investors. Clear, everyone? Any questions, anyone?
No.
Everyone? Okay. Now comes a very interesting thing. Now, we live in a world where investments, couple of years back, investments in domestic equity was also not that lucrative for many, but now many people invest in domestic securities. However, we also need access to foreign investments or investment in foreign securities. Now, foreign securities investment is not that easily allowed. There are restrictions still. There were restrictions in the past, and there are some restrictions still there. However, the trend is changing. So I will discuss what are the barriers in terms of investing in foreign securities or non-domestic equities. Then I will discuss what are the changing trends and how now the barriers have been reduced, and that has helped the global equity market. So we'll discuss about that. And then we will discuss what are the different ways through which companies raise capital from abroad, or the ways through which you as an investor can invest in foreign securities, right? Let's discuss that. So in the past, there were restrictions, strict restrictions for foreign investments, right? We all have faced, the situation where who was that foreign investor in our country who came as a trading partner, as an investor in our country, and then they took over the country for 200 years. Well, that company's name was
East India.
East India Company, right? So we all are, victims of colonialization, and that has been with, that era of colonialization was so bad that gave rise to communalism, communist parties, or the left wing, which were anti foreign investment. And it was not wrong initially, where foreign investments were perceived initially as someone who would just take over and destabilize your country's economy, right? So many countries have these barriers for foreign investments. Of course, those barriers are changing and getting more and more reduced because the world is becoming more and more integrated globally. So foreign investors to global capital flows are not completely non-existing. Some countries restrict foreign ownership. Why do they restrict foreign ownership? Well, to prevent foreign control. Point number one. Also, when foreign capital comes in, they also quickly go out whenever there is something crisis. So that increases the volatility. So governments don't want enough volatility in their capital markets. Third, if a company is coming in my country and doing business, why should not my shareholders be, my investors be a part of that company? So many countries have the policy that if you want to come and do business in our country, you will have to have locals as the stakeholders. Isn't that the case with many countries, including UAE, where if you want to start business in UAE, you will have to have a
Arab citizen.
You will have to have a local Arab as a local Emirati as your partner. Are you getting it? Correct. So many countries have such policies. Of course, I'm aware that these policies are not stringent and the locals are very cooperative in UAE, but that may not be the case with other countries. So these are the blockades through which foreign investors or do not want to come up and invest in your country, or they don't want to come up and do business in your country. So there are many ways through which companies or governments try to control foreign investment in the country. However, we are living right now in a world where many countries are in need of foreign investments. For example, when India and China does a lot of export to the European and American nations, they sell the goods there, then they don't have a right to say in the international market that we won't allow your goods to come here, or we won't allow your companies to come and do business in our country. Well, that's very contrary, right? Because we want our companies to sell goods abroad, but we don't want their companies to come here and sell. That's such a hypocrisy, I think, isn't it? I've heard many people saying that foreign direct investment in India's retail is not good and this and that. Then how come Indian companies are doing business abroad and taking away their jobs? I think we are more to be blamed rather than them. Today, Indian companies are selling goods everywhere, but Indian companies have put so much of restriction on imports that, if you just think it fairly, if you are at the WTO and if you want to take up a decision, I'm sure you would take up decisions against India because of the unfair trade that we do. When we sell goods abroad, we want all the liberty, but when foreign companies try and sell goods in India, we come up with all bombarding on them, right? That's very unfair. Don't you think so? So we want to sell our cars and bikes in the foreign nations, but when foreign companies want to sell cars and bikes in India, we charge them 100% import duty. How is that fair? Isn't it? How is that fair? Absolutely unfair. We've never thought about it in this angle, right? Clear? Everyone? You all there?
Yes, sir.
Or probably you're
Yes.
that no, what is he saying about India? No, I'm just being very honest that we are very hypocrite in that way. Our country wants to sell goods across the globe, but we don't want foreign companies to come here and sell goods. We want them to be controlled. We want them to pay more taxes. We want them to pay a huge amount of fees and so on. But when we do business abroad, we want all the liberty. We want all the visa norms to be, easy and so on. Okay. It's something like, Indians are going all over the world and want to reside and do business and do jobs all over the world. But when it comes to our own country, we are not allowing even other state people to come and do business in one state from another state. We oppose that. So here in the country, we oppose people from other states. But when you go abroad, you want other nations to accept us. That's very strange, isn't it?
Yes.
So I think somehow we need to, before we blame, what's happening in Australia, there's racism happening in Australia, there's racism happening in US against Indians and all. When I hear all this thing, I feel that isn't racism happening in our own country where we blame the other state people? The people coming from the other state are doing business in my state and they are becoming rich. Well, the world becomes better. A nation grows because it acquires talent, and talent comes from anywhere and everywhere. US is where it is today because of its immigration policy, because it has accepted talents from around the world. Can you tell me who's the biggest scientist in our era? In the 19th and 20th century, the biggest scientist or the most genius guy, if you ever remember. The most genius guy.
Steven Spielberg. Yeah, Hawkins. Stephen Hawkins, sir.
Stephen Hawking, okay. And name me few. Who's the one who's come up with E equals to MC square? The one who's done remarkable job in the space industry, in the space.
Albert Einstein.
Albert Einstein. And who was Albert Einstein? He was an immigrant. He was, I think, from Germany, and he was a Jew, and he had to run away during the World War II crisis.
Yeah, from Germany. Yes.
So that's what I'm saying, that US gave him citizenship at the time when Hitler was at his epitome. So I think US has this neck of getting talent from all over the world, and that's where US is right now because of its policy of acquiring talent. They have never stopped talent from coming to US, and that's I think now Canada is doing that, Germany is doing that. They are acquiring talent from the world. So a country which has this open mindset of taking up talents, those country progress. Why are metro cities, why are they doing better than others? Because metros, they take people from everywhere. In a city like Mumbai or in a city like Dubai, anyone can go who has talent, can do business. Anyone can. I'll be very honest. In a city like Mumbai, it's very easy to come up, settle down if you have talent, and you can make a living in this city. So those cities, those countries flourish, which has a very open door policy. Those cities and countries which have a very narrow policy that we won't allow them, we won't allow this, they are always lagging behind the other cities. Clear? So one of the reasons that countries progress is because of their way of acquiring talent from outside. That is their change in their immigration policy. Clear? So now, as I said, since countries need capital, they have started dropping up these financial restrictions. Improved communication and trading technologies have made investments easy, quick, and hassle-free. Now, because of the modern era of trading, you can do everything online. You can invest in any part of the world. You can open up an account anywhere. You can connect your bank account anywhere. So these trends have made it more easier for people to invest globally. And finally, with capitals flowing freely across borders, global financial markets have become more integrated over the time. So now, even if you look at companies, you can't say this is a German company or this is an American company only, because now the investors, the shareholding pattern, if you see, there are shareholders from around the world. So a company like Tesla may have a shareholder from Saudi, may have a shareholder from UAE, may have a shareholder from India, may have a shareholder from China, from US, from UK, everywhere. So in today's world, the companies are more global than they were ever before because of the acceptance of foreign investments and the change in the trends. Clear? So studies have shown that reducing capital barriers have always done a positive job. They have improved market performance. They have encouraged foreign ownership. So you get more and more foreign direct investment in your country. And that has helped increase your branding also. So when companies have investors, like when I say, Paytm has investors in form of Warren Buffett investing in Paytm, then that's a very good recognition for the company. The company generally gets a very good, branding that a foreign investor has shown trust in their company, right? That increases liquidity for firm shares because now you have more shareholders. And since now you have foreign shareholders, they expect you to be more transparent. So you're going to be following more stricter rules and regulations. So that's a very good sign for having a foreign investments, right? Clear? Everyone?
Yes.
Now, there are two major routes to invest in foreign securities. One is that you can directly invest. But remember, direct investment is a bit difficult till now. What is direct investment? Direct investment in foreign markets is where you directly buy shares. Except US, and even though US is not completely easy to invest, many countries in the world don't allow you to direct invest in equities. There are obstacles. What are the obstacles? First, even if they allow, what are the obstacles? You will have to invest in their currency. So you have a currency risk. Correct? When a foreigner invests in your country, so for example, let's say US investor puts money in country like India, China, or Pakistan or Bangladesh, in these countries, they may find that these economies are relatively, compared to their economies, they are more volatile, they are more risky, less regulated, less transparent, and it is very difficult to sell the shares. There are taxational and laws and other issues which you will have to handle. For example, in India, we don't allow the foreign investors to easily repatriate their money. They may have to pay TDS, tax deducted at source, at times. So it's not that easy for foreign investors to come in India and exit, right? They have strict and complex reporting requirements of foreign stock exchanges. So, when you invest in foreign countries, you may have to follow their guidelines, their documentation process. So it's not easy to do direct investments. As I said, most countries discourage direct investment in foreign securities, or most countries by foreign investors in their securities. So most countries they want foreign capital, but they want foreign capital not that easily. Right? That's the irony. So what do companies do? Instead of getting foreign investors in your country, which is very difficult and subject to bureaucratical and other hindrances, what companies do, companies issue their shares in foreign country so that foreign investors can participate in that companies. Are you getting my point? What do companies do? When foreign investors are willing to invest in your company, but they are saying that, no, we want to invest in your company. So for example, let's say Infosys tells that US investors, why don't you invest in my company? But US investors will say that, see, your countries have so much of restriction and other policies. We don't want to enter into those bureaucratical problems. We don't want to stand in queue to fill up the forms, right? Just a joke. But they don't want to go through this hassle of, documentation and other process. So what will Infosys tell? Infosys will tell, don't worry, I will list my shares in your country also so that you can invest in my company. That mode of investment, or that indirect mode of investment by foreign investors, is called depository receipts, DRs. Have you heard about it, everyone? Depository receipts or DRs? Everyone?
Yes.
So what are DRs? DRs are domestically traded securities which represent a claim on a foreign company. So assume you are a US investor. You are now having a share in dollars. You are having a share or a stock which you are purchased in dollar, and this has a claim on, or this has a right or share of a foreign company for you. So let's say a US investor now has a stake in Infosys, which is an Indian company, but that they did not came to India and invest. They were able to invest that in US because Infosys had listed its stock in US in the form of DR. Clear, everyone? So how does a DR work? Let me give you an example. Equity shares of a foreign company. Let's say now for US investor, Indian company is a foreign company, right? For an Indian investor, US is a foreign company, isn't it?
Yes.
So let's say a foreign company comes in India and issues securities, but they don't directly do that. They do it through a bank, which is called a depository bank. So they deposit their shares in a bank, which acts like a mediator or a depository. And you, as an Indian investor, can then go to the bank and buy those securities, right? So let's say a foreign company like Amazon comes in India, gives its shares to, let's say, Citibank Mumbai. So Citibank Mumbai will have shares of Amazon. Now you are an investor in India. You can buy Amazon shares from Citibank. Citibank is a depository where the shares are. So you can directly buy the shares from Citibank for Amazon. That's called DRs. Everyone clear? And these shares can be listed on your exchange on NSE BSE, right? Everyone? That's how DRs work. Now, why do you require a depository bank? You're the mediator, the depository bank, which I said Citibank Mumbai. issued receipts to DR investors, and they take care of the operational activity. So instead of Amazon doing everything in India, Amazon has given all that power to Citibank. Now Citibank will handle your buying and selling. I mean, they will sell you the securities. They will help you with the dividend distribution, with the stock split, or stock dividends, or any operational activities that you want to that Amazon had to do. Instead of Amazon will give that power to Citibank, and Citibank will do with you. Is that clear, everyone? Right? Now, these DRs are issued by Amazon in India in INR or in dollars?
INR.
In INR. So DRs are issued in the currency where they are listed. So an investor like me may not have to buy dollars to buy Amazon shares. But see, the DR's value is based on Amazon's performance, which is in dollar. Amazon is listed in US in dollar, right?
Yes.
So I am actually going to be not only facing Amazon share price risk, which is in dollar, but also the currency risk, because after converting that, even if the share price remains constant, but if the international value of dollar in terms of rupee, if that keeps on changing, then my share value in rupees will also change. So even though I may not have to pay dollars, but I still face a currency risk in DR. Everyone getting this? I'll repeat. When I invest in DR, I may not face dash risk, but I may face dash risk. I don't face the conversion risk. I mean, I don't have to convert the currency, right? But that does not mean I don't face the currency risk.
Currency risk.
I face the currency risk. Is that clear? Remember such points? They may ask for MCQs. They may say that, there is conversion is required in DR. No, it is not required. But currency risk is there in DR. Yes, there is currency risk. Clear? Everyone? Now, these DRs, who issues the DR? Foreign companies. They issue DRs in your country with the help of
Local bank, a country bank.
the country's bank, the local bank maybe, right? Which is called a depository bank, right? Now, at times the companies may not require the depository bank. They may do it directly. Such DRs are called sponsored DRs. In sponsored DR, the foreign company directly does issue the depository receipts. They don't do that job through a depository bank. That's called a sponsored DR. Unsponsored DR is a DR where the depository bank is involved in the day-to-day operations, right? So tell me one thing. Under a sponsored DR, from whom are you buying the share? Are you buying the share from the bank or from the company directly?
Company directly.
Company directly.
From the company directly. Therefore, you have all the same rights as what you were a common shareholder in US. So now I, as an Indian investor, I directly buy the shares from Amazon. I don't have to go through the bank. So I have all the same powers as what I would have had if I were a US investor. So I have the same rights as what common shareholders have. For example, right to vote, right to dividend, everything is fixed. Everything is same. It's just that I don't have to invest in dollars. I have to invest in rupee. Is that clear?
Yes.
That's the case with sponsored DRs. In an unsponsored DR, I don't have that right. I am dependent on the bank, because actually in the books, the bank is the owner of the shares, because the bank has taken the Amazon equity and the bank has resold that to me. Are you getting it? So actually it's a bank which has all the rights. So the voting power is with the bank, not me. Is that clear? That's a minor change in sponsored and unsponsored DRs. What do you think that companies mostly do? They go with sponsored DRs or unsponsored DRs?
Unsponsored.
Everyone.
Unsponsored.
Unsponsored.
Unsponsored, because they don't want to run up with this regulation and day-to-day operational activities. They don't want to get into all this thing. They want to probably go through professionals. And remember, your local bank here may have more reach out to the investors than the foreign company. So mostly companies go through unsponsored DRs. Everyone, right? Clear? Now, there are two types of DRs. One which are listed in US. Those which are listed in US dollar, they are called ADR, American Depository Receipts. Easy, simple. And those DRs which are listed outside US, they are called GDR, Globally Depository Receipts. ADRs and GDRs, very easy. So ADRs are DRs which are listed in US or US exchange in US dollar. GDRs are listed on a London or a Luxembourg or a Hong Kong exchange, and they may be listed in dollars, euro, pound, or any currency. That's why they are called GDRs. Clear? Now, the difference between GDR and ADR, apart from the listing and currencies, is that GDRs are not subject to foreign ownership and capital restrictions. They are more liberal. They are less restrictions. But if you are going to issue ADRs, you will have to follow the regulations by SEC. Okay, so SEC's regulations you will have to follow because you are now listing your DRs in US. Now, if you are going to list your DRs on US exchange, then you require SEC's permissions, or SEC's, you have to follow SEC's regulation criteria. But if you're going to privately place your DRs in US, then you don't require SEC's regulation, but you will have to follow other rules, which is Rule 144A. Do you remember Rule 144A? How would you remember? We have never done it, right? Well, if you go reading 20 FRA, right? In that reading, we have discussed Rule 144. It is a notification to SEC when the company issued securities to certain qualified buyers. The registration is not required, but only a notification has to be given to SEC. Are you getting it? Correct, everyone? So 144, whenever you see 144A, that is with regards to private placements. That is not with regards to publicly listing. But you have to just notify the SEC. You don't have to seek permission from SEC. You have to notify. So conclusion, GDRs are listed where?
Global.
Outside US.
Outside US. They can be listed not only in dollar, but they can be listed in pound, euro, or any other currency, and any exchanges of the world, right? Are they more restrictive or less restrictive compared to ADRs?
Less restrictive.
Less restrictive. Contrary to this, ADRs are listed on US exchange or privately placed in US dollars, and they have to follow the SEC guidelines if they are listed. If not, they have to notify the SEC through the Rule 144A. Is that clear? Everyone.
Yes.
Now I'll show you two important things. One is the 4 different categories of ADRs in US. The 4 different categories of ADRs in US. Now you would say that, sir, do we have to remember it? Unfortunately, I may have to say yes, because this is mentioned in your institute curriculum also. I just try to make it easier here in a tabular manner. And so what are the 4 different types of ADR? Why are we discussing about ADRs more? Because ADR is the biggest market. It's more bigger than the GDR market. And everyone wants to list in US because US, you have seen, US is the largest market, isn't it? Did we discuss that? Yes. See, the world's largest stock market is US, much bigger than all other market. So everyone wants to get listed in US, even if with the US restrictions. Okay, so that there are 4 levels of ADRs. Let me show you all those 4 levels. Level 1. Now, in order for you all to quickly remember, I will focus on level 1 and level 4. I mean, level 4 is basically Rule 144A. It's not a level 4, but it is called Rule 144A. So focused on first and the last one. Okay. Why? Because there are a lot of things common there. First, whenever you are listing shares, what do you want? You want capital, right? And capital from foreign investors. So the one common objective for all the DRs in US is that you get access to US investors. Clear? But under Rule 144A, you also want access to qualified institutional buyers, like institutional investors. Is that clear? So if you want QIBs, you go for Rule 144A. If you want participation by US investors, you go for level 1 unlisted. Level 1 is unlisted. Okay. And rule 144A is also unlisted. So these are not listed. And so where would you find these securities? Well, you would find these securities trading either in the OTC or through private offerings. Is that clear? Everyone?
Yes.
Now, I want your help also so that you remember it. And I'm trying to make you connect so that you remember it. Unlisted ones are level 1 and 144A. You would not find unlisted ones on exchange. You would find them on where?
OTC.
OTC or privately placed. Clear? Now, tell me one thing. If you go on an exchange, the fees are higher, or if you privately place, the fees are higher?
On exchange.
On exchange, the fees are high, right? Because you have to follow a lot of guidelines and all. So the listing fee is low if you are in level 1 or rule 144 because they are privately placed or OTC. Clear? Similarly, if you see the regulation, SEC registration not required, full registration not required. In 144A, SEC registration is not required. You just have to notify the SEC. Remember that? Correct?
Yes.
And you just want to raise capital from foreign. That's the objective. Everyone remembers level 1 and 144A? Unlisted? Clear? Clear?
Yes.
Now see the level 2 and level 3. Level 2 and level 3, what is the thing there? They both are listed. So of course, where would you find them? Well, you would find them on NYSE or NASDAQ or AMEX. Clear? They, of course, you want more US investors there. That's the common objective. But again, because they are listed, their listing fees are high, and you will have to comply with the SEC requirements, with the SEC regulation, right?
Yes.
What is one advantage of listing your DRs on US exchange? Well, you are now, along with other shares listed in US, you also have your shares now listed on US exchange. Is that clear, everyone? So now you are on par with other US companies. This allows you not only to raise capital, but also to take over another company or being taken over by another company. So one big advantage of level 2 and level 3 is that they help you make acquisitions also. Clear? So level 2 and level 3 are quite common. Only the capital and the size may be the difference, but otherwise they are very, very, very common. Clear? So there are 4 different sections through which you can raise DRs in US. Everyone clear with that? Now the difference between them is in terms of filing requirements and other various conditions. Everyone clear? So level 2 and level 3 are almost same. There's hardly any difference. Clear, everyone? Now, so many Indian companies have listed their DRs in US, which is called ADR. Tell me one thing, which is the sector which you think in India has highest business in US? Most of their business coming from
Software.
software and pharma, right?
Yes.
Many Indian companies sell their medicines in US. So pharma, software, banks, you will find these companies which has majority of their clients in US, they also list their securities there. So I'll just share you some of the data of some of prominent Indian companies which have listed their DRs in US, which is the ADR. So you would find them here: Dr. Reddy, HDFC, ICICI, Infosys, Rediff, Satyam Info, right? You have Tata Motors, you have Wipro, all these companies. Why don't I see Infosys? I think Infosys was also there. Yeah, Infosys, yeah. So all these companies are the ones who have their ADRs listed on US exchange. Everyone clear? Right? You can also check out the links here where I have put up the live link for the list of companies which have ADRs, Indian companies which have ADRs listed in US. And there's also a list of UAE listed ADRs. So foreign companies which have listed ADRs in UAE, or you can say perhaps companies which have listed their securities in UAE. All right. So you can probably just check out those links. Everyone cleared between GDR and ADR? Any questions, anyone? GDR, ADR, anyone? Any questions?
No.
Okay. Now, there's one more way of raising capital from foreign, and that is globally registered shares. Globally registered shares are common shares which are not only listed in one country, but they are listed in several countries or several exchanges of the world. So it is common share that is traded on different stock exchanges around the world in different currencies. What does it mean? For example, if I want to buy a share of a company, I want to buy a share of a company in one country, I would find that share, let's say that share is listed in Switzerland in Swiss franc also, and the same share I would find listed in Japan in yen. Clear? So wherever you buy, you don't have to face the conversion risk. Clear? Right? For example, ABB. ABB is an engineering giant. Now ABB is a Swiss company. So it is listed in Switzerland in Swiss franc. But if I want to buy ABB in India, ABB is listed in India in INR. So they are called GRS, globally registered shares. Clear? Everyone? Same goes with Pfizer. Pfizer is listed in
UK.
US, UK, everywhere. In India also Pfizer is listed, right? But I don't have to pay Pfizer's share price in India in dollar. It's listed in Indian rupee. Clear? So you are getting the ownership. The purpose is that you get actual ownership of the company, but you don't have to, you can buy that company share in your country, from your country's exchange in your currency, because they are globally registered. They're globally listed. Clear? Everyone? That's called GRS. Everyone?
Yes.
And the second way is like a mutual fund of DRs. What is mutual fund? Mutual fund is a portfolio of securities. So portfolio of DRs is called basket of listed DRs. So BLDR is like an ETF, which has a basket of or a portfolio of various different DRs listed. And those DRs, you can, that basket of DR, you can buy and sell like a stock. That's why it's called an ETF of DR. Everyone. It can be used for hedging or arbitrage or trading or speculation or anything. Well, compared to directly investing in one DR, if you invest in basket of listed DRs, the biggest advantage that you get is diversification. Is that clear? So BLDRs offers you diversification. So if I am an investor in US and I'm confused between which domestic receipts I should invest or from Indian companies, I would rather buy a basket of listed DRs, which may have not only one DR, but a group of DR. So it's like buying a mutual fund of listed DRs in your country. That's called basket of listed DRs, which gives you a very good diversification. Is that clear, everyone?
Yes.
Right, everyone? So this is what a major discussion was with respect to non-domestic securities. Now we have a very small portion left, which you are all aware about, risk of equity securities and return of equity securities. Well, returns, you are always aware, return comes in two forms. When you invest in equity, well, you get returns in two forms. One is dividend, and second is change in price, which is P1 minus P0, isn't it? Those are the only two ways which you get returns, isn't everyone? You invest in equity securities, you get dividend or change in price. Change in price is what we call as capital gain or loss or growth. Correct? Everyone aware about these two forms of investments,
Yes.
two forms of returns? Apart from this, you can also consider two other forms of returns, the reinvestment of dividend. If you are reinvesting the dividends, even that is a return. Correct? And if you are investing in foreign securities, then it's not only the return on the stock, but even the currencies can play a big part in your return. So currency exchange gains or losses in case of foreign investments. Is that clear? So two common returns are dividend and capital gain or loss. Correct? However, there are other two forms of returns that you may get from equity. That is reinvestment of dividends. And the fourth is?
Currency exchange.
And currency exchange gain or loss will only happen when you are investing in a foreign security. Is that clear, everyone? Right?
Yes.
Now, we all know the returns formula P1 minus P0. That is a price change plus income divided by P0 into 100. That is returns. Now, risk, well, we have learned about risk in QM, and the risk is nothing but standard deviation. So in terms of equity, whenever we talk about risk, it is always about standard deviation. We are all aware about the standard deviation formula. Here I've put the standard deviation formula of the sample. That's why you see in the denominator n minus 1. Had it been population, the denominator is n. Everyone aware about standard deviation? I'm not going in detail because we've done decades of studies in QM about standard deviation, right? So in equity, the risk is in percentage. The standard deviation is also in percentage, the risk. Now, in terms of different types of equities, which is the most riskiest? Well, common equity is relatively more riskier than preferred equity. Preferred shares are less risky. Why? Because they have priority of claims. And you remember there are callable and puttable preference shares. So which preferred shares are less riskier? Puttable preference are less riskier than the callable shares, because in callable, the issuer has the right to call back, right? So if I compare puttable, callable, and in between, I say non-puttable, non-callable. So those which are non-callable, they are much safer than even the callable shares. So which out of the three, puttable preference shares are least riskiest, followed by non-callable and then callable. Callable are the more riskiest because there the issuer has a right to call back. Is that clear? Then which type of dividend is better? I mean, the cumulative or non-cumulative? In cumulative, your dividends are accrued. So cumulative is better, right? So cumulative preferred shares are less riskier than non-cumulative because they assure you the safeguard of your unpaid dividends. Your unpaid dividends are not thrown out. They are not forfeited. So cumulative preferred shares are relatively less riskier. Everyone clear?
Yes.
Right? Everyone, risk and return of equity securities. Any doubts, anyone?
No.
No? Now, there are some prominent ratios which we are going to discuss in equities. But before that, two very important things that people need to understand about equities. One is the book value and the market value. Are they both same? Of course not. Book value, which is also called, if you remember from FRA, book value is also called, tell me. Have you heard about this word?
Carrying
value. It is the value of your company's equity based on your balance sheet. Net assets, that is assets minus liabilities. That equity as per the balance sheet is called the book value. However, this book value is based on historical operating and financing decisions, isn't it? And who decides that? Management. Clear? Contrary to this, market value is the value of your equity based on the current market price and the number of shares. Now, book value is published, let's say balance sheet is published at the end of the year. So that remains constant. But the market value of your company keeps on changing every day because your share prices keep on changing every day. So this market value is based on the current prices and the number of shares. So the market value does not only represent the past data like book value, but it also, apart from that, it also has expectations of company's future performance, isn't it? Everyone.
Yes.
So the extra thing that is in the market value, the reason why market value may be different from the book value is that market value also has company's future expectations in it. Clear, everyone?
Yes.
So the book value can be influenced by management, but market value is less influenced by management. It is more influenced by participants, the buyers and sellers. Everyone. Now, if I want to find book value per share, I will take total shareholder equity divided by the number of shares. For market value per share, I need to have the number of shares outstanding, multiply that with the price of the share. Clear, everyone? The formula book value and market value per share. Easy. Now just take this. So tell me one thing, is the market price, the price of the share, and the book value per share, are they going to be same?
No.
No.
No, they can be very different, right? So we always see a ratio of price to book value where we compare the market price to the book value, right? The higher this ratio, the costlier will be the share. So this ratio tells us how much investors are willing to pay for every dollar of book value. Let's say if the ratio is 2, that means for every $1 of book value, the company's share price is twice. So this price to book value ratio is also called as market to book value ratio. It indicates the value of the company compared to its book value. That is financial reporting, right? The larger the price to book value ratio, the more the value of the company, right? Of course, this is more like a P ratio, price to book value ratio. You compare and can't conclude that this is a good or bad thing unless and until you compare that with the peers or with the industry. So like PE ratio, price to book value ratio, is compared with the industry, and then you can decide whether it's compared to the industry, whether it is undervalued or overvalued. Is that clear, everyone? So what is price to book value ratio? It is market price per share divided by book value per share. Whenever this ratio is greater than 1, it indicates that the price is greater than book value. If it is less than 1, that means something is really opportunistic or something is really wrong with the company, where the company's price is less than its book value. Are you getting it? Clear? Now, based on this also, we calculate one more ratio for equity shareholders, which is called accounting ROE, which is simply what we call as return on equity. Guys, you remember the return on equity formula? Net income over total equity. And here total equity, I mean by book value, accounting book value, not the market value. Everyone. So when we calculate ROE, return on equity, for equity shareholders, what is available in the income statement? After paying everyone, that is net income, right? Clear?
Yes.
And in the denominator, we have total value of equity. This value of equity is not as per the market value, but as per the book value. Therefore, ROE is also called as accounting ROE. Everyone. You need to remember that ROE was also calculated using DuPont analysis. Everyone recollects DuPont analysis? DuPont analysis. Let me take you all to DuPont analysis. Everyone see this way, DuPont analysis, 2-way, 3-way, 5-way, correct? So you can also find ROE using DuPont analysis. Okay. Now what is the one big thing about ROE? What is that we use in the denominator in ROE? Book value, which is influenced by the management. Even the net income is influenced by the management, right? So even the management knows that people are going to watch ROE. Therefore, there is a very high chance that the ROE can be influenced. Therefore, we should not always conclude ROE increasing as a good sign. We need to, as analysts, we need to check that, right? What if the ROE is increasing because the net income is decreasing at a slower rate than the shareholders' equity? So the net income has fallen. The shareholders' equity also has fallen. So the denominator has fallen more and the numerator has fallen relatively less. Now both are negative signs, right? But you'll still see the ROE is better. Why is that case? For example, let's say your ROE initially was, net income was 10 and your book value was 100. What would be your ROE? 10%, right? Everyone? Everyone, right? 10 over 100, net income over book value will be 10%. Am I correct? Yes or no?
Yes.
Yes.
But now see, ROE increasing is a good sign. But what if my ROE, my profits fall to, let's say 9 and my ROE falls to 50? Well, if you do 9 divided by 50, that's going to be more than 10%, right? But that does not mean I have done a better job. Clear? There the rate was low. The ROE has actually increased because of the mathematical issue, where the decrease in net income was slower than the total equity. That's why you see ROE improved, but that's not a good sign. Are you getting me, everyone? Clear? So you need to check ROE. Even ROE can increase if the company issues more and more debt and then uses this amount to repurchase equity. So the company is using more and more debt, so your denominator is getting reduced, right? And even by that way, companies can spike up their ROE. So you need to be alert as an analyst that ROE increasing is a good thing, but you need to check how are they increasing the ROE, because there is a very high chance of it being manipulated by the management. Clear? Everyone? Right? So quickly tell me the formula of ROE.
Net earning divided by book value.
Book value. Now remember, the book value is actually taken as average. Why? Because here you are comparing numerator and income statement and denominator a balance sheet item. If you remember from ratios,
Yes.
you always average the balance sheet.
Balance sheet.
For the average, you need opening and closing. Means you need the beginning of the year and the end of the year book value information. Clear? At times they may not give you end of the year. In that case, you will take only the beginning of the year. I'll repeat, at times they may not give you end of the year. In that case, you will only take the beginning of the year information. Is that clear?
Yes.
Right. So just depending, if they give you both information, take the average. If they don't give you, just take whatever they give you. Clear? However, if you have both the years data, it is better you go for average. Clear? So ROE formula done. Can you tell me what is the formula for book value per share? Come on. We've done everything. Total shareholders equity divided by shares outstanding. That is book value per share. Market value per share. Total market value divided by shares. Or if you want to find, this is market value, not per share, total market value. Total market value is market price per share multiplied by share outstanding. If I do market value divided by total shares outstanding, I'll get market value per share. Is that clear?
Yes.
Right? And finally, price to book value ratio is market price per share divided by book value per share. So are you ready to do an example with me? I'll need your help. I hope everyone has calculators. So how many years data do you have for ABC and XYZ? 3-year data.
Yes.
So which years you can take the average? Like which years data can you calculate? You can calculate for
19, 20.
19 and 20, right? Where for 19 you can take 18's data also. These are end of the year data, by the way. Everyone, right? So we will calculate for 19 and 20 everything that we know. Guys, in order to calculate ROE, what is the first thing that I need?
Total.
Net earnings.
Return. Net income is already given. I need average of book value. Average is last year and this year's value divided by 2. So in your calculator, I need you all to find the average of book value for ABC for 1890. Everyone, let me know your average value. How would you do that? Add 2050 plus 2075 divided by 2. 2050 plus 2075 divided by 2. You'll get an answer. Yes. 20625. Am I correct?
Yes.
2062500. That's my average book value for 2019 for ABC. How about for 20? I will do 2075 plus 2100 divided by 2. I'll get 20875. 2087500. Clear? Net income is already given for 1920, 102,000 and 102,300. So I'll take here 102,000, 102,300. So guys, if I have net income and if I have the average of book value, I can get ROE. Let me know your ROE answers, everyone. 102,000 divided by 2062,500. Yes. Let me know what is your book value. ROE, sorry. 102,000. Okay. So 102 divided by 206.
4.95.
Sorry?
4.9.
4.95.
4.95. Clear? The same way for 2020, 102,300 divide by 208,7,500. I get an answer of 4.90. Clear? Everyone?
Yes.
Now they've already given me the price of ABC is $90 for, I have the price of ABC and XYZ for both the years. So we will actually find, now we don't have the price for 2019, right? We just have the price for 2020.
20.
So I have the price and they have asked me for price. So price is given. I will write here the price is $90 for 20. So market value, I can find the market value for 2020, right? They have given me the number of shares as 70,000. So 90 into 70,000. That will be the market value. I'll get 6.3 million. So 6300,000. Just check it if it's correct, everyone.
Yes, sir.
Clear? So you have 70,000 shares. Can we find the book value per share for 2019 and 20? Now don't take the average, just take the book value of 19 and 20. So you have 2075 divide by 70,000 for 2019. What is your value?
29.64.
29.64. I get here 29.64. And same year, I will take, I'm assuming there are 70,000 shares in 2019 also. Okay, that's the assumption here. Have they given me? I will take it. If not, you can simply calculate for 2020. So for 2020, I have 22.1 million. So I will take 2100,000 divided by 70,000. I'll get 30. So here I will take 30. Since I was not given, you can simply skip it. They have not asked you. Remember, you have a multiple choice question, so they'll ask you specifically. Here, I've just created a sum for your reference. So you can write your book value assuming that the shares are same, or you can simply do it for 2020 because you have only 2020 data available. So if I now want to calculate price to book value ratio, well, I have the price as 90 and I have the book value as 30. So 90 divided by 30, I'll have price to book value ratio as 3. Is that clear, everyone? Right? Everyone. If they had given me the shares and the price for 2019, I would have calculated the price to book value ratio for that year as well. Is that clear, everyone? So in this way, we can calculate ROE, we can calculate market value, book value per share, and price to book value ratio. Any doubts, anyone, till this point? So in the same format, I want you all to try for XYZ. The question is here, I want you all to try everything. So I'll just put it here, everything. And please try everything. I'll give you all around 2 to 5 minutes to solve this. Find the average book value for both the years. Based on that, find the ROE, then find the market value of the company, then find the book value per share, and finally price to book value ratio. Right? You have all the information. Take 2 to 3 minutes and solve it and let me know. Take your time. Okay, have you all solved? Everyone? Hello?
No, sir.
For XYZ, the average of book value is 2105 plus 2000 divided by 2. 205 to 500. 205 to 500. Am I correct? Then you have 2150 plus 2105 divided by 2. 21275. So here it is 2127500. Let me know if this is correct, everyone.
Yes.
Right? Here you had net income of 152 and 153 300. So it was 152,000 and 153 300. So 153 300. So your ROE in the first case, anyone? 152 divided
7.4.
7.36.
7.40.
40.
I get 7.40 as the answer. Correct. Is it right, everyone? Yes, no?
Yes.
The second one, 212, okay, 153.3 divided by
7.2.
7.5. I get 7.21. 7.205, so I'll do 7.21. Correct. Price. I have price of 2020 150. So my price is 150, and if I take the market value 150 into 90,000. So 150 into 90,000, I'll get a value of 13,500,000. Am I correct? Is it correct?
Yes.
13,500,000. I'll check it again. 90,000 into 150. So 90,000 into 150. I have severe problem with zeros, and I don't hesitate to accept that. So 13,500 and 3 zeros. 13,500,000. Everyone. Now my book value per share, I had 90,000 here. So for 2019, it will be 2105 divided by 90,000. I have 23.39. Correct? And then I have 2150 divided by 90. I'll get again the same thing. Correct? Is it the same? No. Did we do something wrong? 2105 divided by 90. I get 23.39, and 2150 divided by 90. How come I'm getting the same amount? 2105 divided by 90. I get 23.89, right? And 2150 divided by 90. I'm getting 23.89. Sorry, 89. I thought it's the same thing. Clear, everyone?
Yes.
So my price to book value ratio for 2020 will be 150 divided by 23.8, and I'll get 6.23. Correct?
Yes.
Everyone? This is how you should be ready for whatever they ask. Of course, it's going to be coming up in an MCQ, so you'll have choice, so you can easily mark it, but I'm not putting up here the choices. Clear, everyone? Any questions, anyone, with ROE, book value per share, market value, or price to book value ratio? Which company do you think is relatively costlier in 2020? ABC or XYZ, if they both are in the same industry?
XYZ.
XYZ. Why? Because it is charging you $6.23 for every dollar of a book value. Compared to that, ABC is relatively undervalued, I can say, right? Everyone? Because ABC is just 3 times more than its book value. Is that clear, everyone? But you should also see that XYZ gives you more ROE than ABC, right? So your decision should not be only based on value, but various other factors. Any questions, anyone? Any questions, anyone here? Anything? So let's move to the last part of this topic, that is cost of equity. We have discussed everything about equity. So how much do equity shareholders want? Well, what equity shareholders want is what we call as required return by equity shareholders. But from the company's side, companies have to pay this minimum to the shareholders, right? So it is called as cost of equity. So it's the same thing, but when you talk it from the issuer side, you call it as cost of equity. And when you call it from the investor side, you call it as
Returns.
required return for equity shareholders. So whenever they say required return for equity shareholders or cost of equity, it is the same. One from the company's side and one from the investor's side. Is that clear? So cost of equity is usually a proxy for the equity investor's minimum required rate of return. Therefore, KE, which is cost of equity, which we've done in cost of capital topic, is also called as E of R, that is expected return for equity shareholders. How do we estimate KE? Well, there are two ways to do that. One is capital asset pricing model, which we've already covered, which is RF plus RM minus RF into beta, right? We've covered this part
Yes.
by Professor William Sharpe, right? And the second part is what we are now going to cover in detail in dividend, that is called dividend discount model. Dividend discount model is also called as Gordon's growth model, where KE is D1 over P0, D1 over P0, D1 over D, that is dividend, 1 next year dividend. So D1 over current price, P0 means price today. D1 over P0, it's called expected dividend yield. What is it called, guys?
Expected dividend yield.
Expected dividend yield plus growth. Growth is nothing but change in the price. So growth is nothing but change in price or capital gain. That's the two things you want from equity investments, right? Dividend and growth. So dividend discount model, we will learn that in more detail when we'll do equity valuation, our last reading in equity investments. That time we'll understand the derivation of this. But there are two ways to find cost of equity or required return for equity shareholders. One is through dividend discount model or Gordon's growth model. Second is CAPM. Once you get this cost of equity, then you take cost of debt. And when you take the weighted average of both, what do you get?
Cost of the firm.
Cost of capital, weighted average cost of capital. So when you take the cost of debt, 1 minus T, remember that? Cost of preference shares and cost of equity, that becomes your overall cost of capital or weighted average cost of capital, which becomes your discounting rate for evaluating projects. Clear, everyone? Right?
Yes.
What do? You compare this weighted average cost of capital with the project's return, IRR, and then conclude whether the project has to be accepted or rejected. Real? Correct, everyone? Any doubts, anyone?
No.
So what all things we have covered, guys? We have understood, we have discussed about the global financial markets, where we discussed all these charts and the trends, right? Then we covered different types of equity, common and preferred equity, private investment in equity through VCs to buyouts and through PIPE, right? Non-domestic equities, where we understood direct investment, and then majorly we discussed about depository receipts, especially ADRs and GDRs. And then there are other ways of investments, that is through globally registered shares or BLDRs, which are ETF of different types of DRs. Then you understood the risk and return part of the equity, where the return is nothing but P1 minus P0 plus income, right? Dividend and capital appreciation. And the risk is standard deviation, where the preferred shares are less riskier than common equity. And then we understood ROE, book value, market value, book value per share, and price to book value ratio, which will give you an indication as to, compared to the book value, how the market value is different, and then which share is undervalued and overvalued. Finally, we understood cost of equity, which is nothing but it is going to be the hurdle rate or the minimum rate that you require when you do equity investments. So this is the overview of equity that you need to know before you do the equity valuation. Correct? That's it. That's the end of this topic. Anyone has any doubts with this topic? Anything? Anyone?
No, sir.
I wanted to ask you in the ADR,
Right.
in the depository receipts.
Yes. Mhm.
So the in the ADR especially, the list which is given of all the companies, is that
Are you
the
talking about the Indian
sponsored or
ADRs?
yes. These
Okay.
ones are these are all like not sponsored ones, right?
See, they are directly listed on US exchange.
Stock exchange. Mhm.
So now these are not privately placed. Well, there may be several other DRs which are not listed. They may be in OTC. I'm just showing you the snapshot of which ones are listed. So in this case, you don't have to go through a bank. These DRs are directly available on the US exchange. So you can buy and sell them. Correct?
Mhm.
Now, there can be other ADRs which you will not have listed on US exchange because you may find it very difficult to go through the SEC regulation. So you may privately place them, or you may do an OTC type of a listing. In such a case, you may require a bank to be a sponsor. Okay. So
Okay.
most of the things that you see here are basically sponsored DRs, the listed ones, where the company directly lists the DR.
Listed. Okay.
Right. Otherwise, you will, especially as I said in Rule 144, where you have to find a QIB. In such a case, it's better you go through a unsponsored DR, where the banks will help you find the investors. That happens more of in a private placement.
Okay. So mostly which are listed, they are sponsored ones.
Because see, these all companies are very famous on the US in US markets.
Mhm.
Many of them have business in US markets. I don't know how come MTNL is there. And if you see the MTNL's value is also very low. But apart from that, most of the banks and IT companies or pharmaceutical companies, they already have major business there, right? That's why they being listed there does make sense. And they may not require a bank to sponsor it. They may directly list them because they are very famous there. Clear?
Yes.
Right. Yeah. Any other doubts? Anyone has any doubts with equity securities? I've done a bit in depth about this in the notes as well. So just for your understanding, so it becomes easier for you for the other topics. Clear, everyone? That's it.
Yes.
If you do not have any doubt, we will take a break and we'll meet after the break and we'll continue with the next section. Okay.